All right, here we go. So, Eric, it's good to see you.
Good to see you too, man.
It's been a long time since we were able to sit down and
Has.
shoot one of these.
It has. This new setup you've got is pretty awesome.
Yeah,
it
thanks.
looks fantastic.
Yeah, we definitely got to make a point of doing this more often.
Yeah, I
now
think
that we have
so.
this.
I think so. With this new gear, why not, right?
Yeah. So I guess today, I think mortgage interest rates and all that type of stuff has been top of mind for a very long time. But there's a lot of stuff going on right now that we haven't seen in a while. So I wanted to maybe start off, hand it to you, break down really. I guess, everyone knows about Bank of Canada coming down, but from our talks in the office, there's a lot more going on that the public isn't aware of.
Yeah.
And that's really why I wanted to sit down with you here so you can tell us about it.
Yeah, for sure. I mean, the good news is that now we're not at a standstill. It's no roller coaster. We know rates are coming down. I think that's the positive. We've been in the high 5% for a very long time, and now, as we move forward, we're seeing the rates come down, which is good for a lot of people. It's good for the first-time home buyers that were sitting on the fence, waiting for the interest rates to come down. Well, guess what? They're down. We're hitting all-time lows that we haven't seen in a very long time. And the main thing for the first-time home buyers that are on the fence is a lot about the qualifying. So we talk a lot about rates and what you're going to pay, and that's very important. But we sometimes forget that we, as mortgage people, have to add 2% to the rate in order to qualify you.
Yeah. So before you go a little bit further, I just want to make sure that this is all going to get recorded properly. Maybe move that a little bit closer to you, just in case. I'm not really sure.
You could see it on
okay.
the side there.
Yeah.
That's fine. So you want me to start over?
No. I think it's okay. All right.
Well, where are you going to clip it?
Oh, that can be still in it, right?
Okay.
You know what I mean?
Sorry.
Fair enough, right?
Yeah. So we don't talk a lot about the qualifying rate, which for us we have to qualify 2% above whatever rate they get. So by the rates going down, that means the qualifying goes down, which means that people that were not getting pre-approved with the amounts that they needed to get into the market now have a better chance to get into the market, just because the rates went down, therefore the qualifying rate went down. But you brought a good point, because everybody is talking about the Bank of Canada and Bank of Canada and Bank of Canada, and as I talk in our meetings, the Bank of Canada is nice. They lower the rates. They look at the inflation numbers and seeing where the economy is going, and make decisions with those factors, bringing down the interest rates for variable mortgages and lines of credits that are adjustable. So a lot of people are not informed to the fact that, when they see the Bank of Canada lower the rates, they're all happy. But in the back of our minds, we're looking more, at the 5-year bond market, which is the indicator of if the rates are going to go down on the fixed side of things, okay? So when the Bank of Canada announces it's good, the variable goes down, the payments go down for the people that have variable mortgages or lines of credits that are adjustable. But the fixed rate, nobody really talks about where that comes from. So, we do have a chart, and I'll show you here, of where we actually get the Bank of Canada rates. And so not the Bank of Canada, but the fixed rate.
Yeah, and I guess for anyone watching too who's not really actively looking for a mortgage or aware of what's going on, we're talking about variable versus fixed, and how many people are going fixed versus variable right now?
Great questions. If we were looking at until now, a lot of people were on the fixed terms, taking lower terms, so 3 years, 4 years, just to because they know the interest rates are going to go down, so they don't want to go onto a full 5-year term. Right now, as we're seeing the rates go down, we strategize a little differently, where if you can, we're talking about the variable mortgage a little bit more. The variable mortgage is higher than what you're going to get on a fixed term. The strategy behind it is go on a variable term, and in 6 months to a year from now, when the interest rates have gone down significantly where we think they're going to go, then you can lock into a fixed term at that moment. It'd be a shame that you lock into a 3 or 4 year term at 4 point something, and in a year from now, we're seeing low threes. So that's the strategy. Not everybody can go into that strategy because of the qualifying, as I indicated earlier. Because the interest rate is higher, your qualification is higher. So not everybody is going to be able to use that strategy, but that's what we're trying to inform our clients in those two options, depending on if they can qualify or not, right?
For sure, and because I'm aware, because we've had this conversation already. But up until now, it's really been primarily fixed.
Fixed.
Am I right? Yeah.
Oh yeah, it's been close to 2 years. We're on the fixed term here.
Yeah.
Because we were on a interest rate trend that was going up. So people wanted to lock in before it went too far. Now we know that we're on a trend going down. Yeah. So the fix might not be the best option for you.
And so, and I guess that kind of, it's like two things to explain here, because up until now, the bank account announcements that everybody's been excited about hasn't really affected home buyers purchasing, because they've been going with the fix, which is what we're about to talk about, and I might be jumping around a little bit.
No, that's fine.
But now going forward, the Bank of Canada announcement might mean a little bit more if we start to see people switching more to variable for the people purchasing.
100%. It's becoming more affordable for people to take the, I say risk because variable is always a risk, but we know that the trend is going down, so limited risk when you're looking at the variable term. So it's going to be the talk going forward with all our clients to strategize and see if that's good for them. A lot of people don't like the variable. They don't like the up and down, and they like the fix. So by all means, to each their own. But as a mortgage broker, it's my job to let them know the two differences and the risks and the rewards to gain from it, right?
So I'll stop jumping around, and if we're a buyer right now and we're looking at fixed and we want to predict what's going on with the fixed rate, or we want to know what's going on with the fixed rate, what is this going to tell us?
This is the beauty, I look at this 100 times a day. Like it's what can show us what's going to happen with the interest rates in the next week. So we're able to predict a little ahead of time before the banks and the lenders start lowering their rates. So if we're looking at the 5-year government bond, and again, this is strictly on the fixed, okay? That doesn't have anything to do with the variable term. But this is what we look at when we look at a fixed term. So right now we're at 2.75 in the 5-year bond market. Usually, and I say usually because it's at the discretion of the lender or the bank. Usually, if you're putting 5% as a down payment on an insured mortgage, you're going to add about 1.5% to that number, okay? And then when you're doing more than 20%, you're going to add 2%. Now, lately we've seen some smaller numbers from the lenders trying to get business, trying to gain market share, because we're sort of at the end of the year where the numbers are out and they need to regain some market share. So there's going to be slightly higher discounts. But when we're looking at it at 2.75, I mean, this is the lowest that we've seen since July 2022. Okay, so if we look at the big graph, I'll put it over 3 years here so we can have a good understanding of the market, but that's 3 months. Here you go. So, obviously this is, COVID times, low interest rates that we saw, and then it sort of started climbing up. So as we are looking end of May 2022, the 5-year bond market was at 2.97. Now we're at 2.75. So we're gaining some ground in that respect, and we're going to be seeing in the next couple of weeks, in the next week or two, I think we're going to be seeing some insured mortgages at 3.99. So I think it's going to be the first time in a very long time that we're going to see a 3 in front of the rate, which is going to be good. The 20% or more will follow, probably closer to early next year, February, March, April, around those lines. They're going to be hitting 3s as well. Where, you know, the new norm might be an insured mortgage being at 349, a non-insured mortgage being at 389, 379. Again, with the spring market, they might discount a little bit more, but I think that's sort of the pocket that we're going to be in for a little while. So very interesting. You know, we look at this every single day to sort of forecast what the lenders will do. And I think that's not talked about enough. I think a lot of people don't know this is a thing. They focus on what the Bank of Canada announcements are going to be. And I think, you know, the Bank of Canada is saying they're gonna keep bringing down the rate in November and December. So we'll see what happens there. But I think after December, I think the Bank of Canada announcement will just become what they used to be, where we didn't really pay attention to it. You know, it wasn't even a thing until it started really, you know, going up. So that's what we look at. That's how we're able to forecast exciting times in the rate. It was a roller coaster for so long that nobody knew what was going on, and now we can firmly say that they're going down.
Yeah, and I think the biggest eye-opening for me is because, you know, we've been following this bond rate for a while because of, you know, everyone going fixed and trying to predict. Because on my side of things too, just for everybody watching, we need to pay attention as we represent buyers and sellers of what's going on with the interest rate. Because where you're able to predict, you know, what's coming with the interest rate, with the bond rate, we're able to predict a little bit of what's going on in the real estate market with what happens with the fixed rate currently, right? And what will be on both rate sides soon. But I think the biggest thing for me that I'd love to have you talk about a little bit more is that we think that when the interest rate comes down, you know, our payments go down, which is true, right? But the biggest difference that you're articulating to me is actually the qualifying rate, right? So yes, you're going to save money. Yes, you're going to be paying less in interest. But, you know, the difference in qualifying rate, which is huge, that no one's really talking about, because as real estate agents, most people don't know, is the difference between owning a home or not, really. So you tell me a little bit about that.
Yeah, like I've got a nice graph for you that I did. We'll take it off of this here. There we go. So here we have, and I'll put it in the full screen here.
Just right to the left of your cursor there.
It's a little small, but we'll see it on the screen anyways. But, you know, average income for a family of 100,000. You know, we put property taxes and heat in there, and we put the qualifying rate here at 5.99, which would mean that your rate would be 399.
Okay. So this is the new qualifying rate.
That's right.
Yeah.
That would give you a purchase power of having a mortgage of 343,000, let's call it. And then if you're looking at what it was, you know, same criteria, you know, you were pre-approved at 324. So there's a difference of very close to $25,000 in purchasing power. Now, it might not seem like a lot to everybody, and when you get pre-approved for 400,000 or 450,000, and you're able to get 475, 480, that changes the bracket a little bit of what you're going to be able to get into the market. Either it's a condo going into a townhome, or a single family home going into a slightly more expensive, less competitive.
For sure. I mean, I can speak to this part, right?
Yeah, go ahead.
Because like what we're looking at right now is, you know, 25K, which is great. But what's the total mortgage amount on this again? So 324.
So yeah, we're talking about mortgage amount, right? So not really necessarily purchase price.
Yeah.
But we've seen these numbers depending on, you know, income, depending on the debt load. Right now I've got nothing, but depending on the debt load, we've seen it up to upwards of $50,000 difference.
Well, for sure,
Right.
because I think even yes, we're talking about mortgage amount being 324, but even that means the purchase price is somewhere around 400K, something like that. You know, that is
Depends on the down payment, right?
yeah, for sure. But I mean, that is not even when you're talking about 25K in that price bracket, that's the difference between owning a home or not.
Exactly.
Because you really can't buy a house for a certain price point, right? Like nothing's selling. Even that's really tough, right? You're talking condo or you're talking somewhere outside the city.
Yep.
But I mean, if we take this math and then we look at the average home price, right? So being, you know, close to double that. I mean, at least, you know, at least 30% more than that. And so if we take a look at 25K difference, then yeah, we could easily be talking, you know, 40, 50K difference, right? And so just where, like, I want to speak on this a little bit because it's wild, right? I think I'm going to go on a little bit of a rant here too,
go ahead, yeah.
because it's tough, right? So when we're talking about the bottom price point, it really is different between owning a home or not. But when someone is looking at a townhome at 600K, right, or a townhome at 625, something like that, they are in one of the toughest markets that they can be in because everybody's approved for that, right? And so it's often really hard sometimes when clients are approved for that amount and then they see what is selling for, you know, if they're approved at 625, say, they see what's selling for that and then they see what's selling for 675 and they're saying, well, look at that house is amazing. This house, because this house has this and this, is not worth 50K less. But the difference is the amount of demand that is at the 625 range versus the 675 is a different world, right? And so when we're talking about people being able to up their approval, that's the difference between in the bottom of the price range, like them owning a home or not, but then the majority of the price range, or like we're talking about average cost of a home right now being around the 600K mark, it's the difference between owning a home that you want and owning a home that you don't want. Right, and I think that to me is the message that I really want to like hammer in on there because it's the toughest thing when we're trying to help buyers of what it is that just that little bit amount, you know, and obviously too, you know, not saying that you have to go to your max, right? But having the ability to buy the home that you actually want versus settling for something that you're not happy with, you know, it's the world of difference.
100%. It's an emotional roller coaster, right? Where if you're standing at the 625 mark and you're competing against 10 other buyers and all of a sudden you don't get it, but like when you find a house, you fall in love with it. When you fall in love with it, you put an offer on and then you're being told no. So it's like you're breaking up, right? And then you have to fall in love with something else. So emotional roller coaster as to what you want. And if you're able to go to the 650, 675 mark where now you're only competing with 3, you know, it makes a world of a difference on you owning a home or you owning that home or not, right?
Yeah, and so I mean, I guess right now where we are, you know, bond rates at its lowest, fixed rates at its lowest in a long time, but you are predicting that we are going to see it get lower.
Yeah.
Still, yeah.
Again, looking at the pocket, I'll throw out a last one for you here where, you know, we're going to be able to see a little bit more on the people that are waiting longer. So it's a fine line, right? Right now, as soon as we hit a 3 in front of that rate, you know, it should become very busy in the real estate market. If people are still there saying it's not low enough, well, you might wait yourself right out of the market because we know once it gets busy, you know, and you can speak of that too, that home prices just go up. It's just the nature. It's how it goes, right? Yeah. So on this graph that you see here is the difference between waiting and not waiting, right? So right now, if you're looking on the left, you have a mortgage amount of $500,000 with the interest rate that is now at 3.99. Now your payment is $26.27. Okay. If you're looking at the right side, I upped it by 50 grand because if you wait for that long, the house prices went up. So I used $50,000 as an example. So your mortgage amount is $550 with the interest rate of 3.49. So I cut the interest rate by 50 basis points. Okay. And your payment is higher.
For sure. And I mean, I guess for anyone who's watching and seeing the price go over 50K, thinking that that's not realistic, it 100% is, right? Looking at how the market changes year over year, right? Even if we go back, I don't know if you have the other graphs that I sent
Yeah, for
you.
sure.
So realistically, yeah, so there's one, for example, right? But I think let's look at the other one first.
Sure.
So that's the last 12 months. But here is going to take a look at the average price of homes since 2005, right? So 19 years with the average price going up 161%. And that's also with, we'll get into it earlier, but the last few months, the price is dipping already, right? But so we average that out, we look at 8.5% per year, right? And so, that's not including the major swings that we have when the interest rate changes, right? You see that massive peak right there back starting in 2020, you can see the jump, and then again 21 and then 22, right? And that is because the demand for homes went up so much when the interest rates went down, right? And now we've been seeing the prices, aside from 2022, still climb, and every year it ebbs and flows, and I think that's what we're going to take a look at the next one, right? But the conversation that I have a lot of time, the conversations that I've been having with people since 2019, then it was waiting for prices to drop, then things got crazy, right? And we're not going to see that again. The interest rates were so low, and the world was a really crazy place, everyone working from home and that type of stuff. But traditionally, what you're seeing right now is it's the last 12 months, but it's pretty typical of most years, right? Because what we see is we'll see the demand start to die out near the end of the year. And when demand dies out, say there's 10 buyers looking and now there's only 2, and homeowners need to sell, then naturally prices will decrease, right? Because it's supply and demand. And then you have at the beginning of the year, because what people don't think about as well is that it's not just that homes don't sell, right? Like why we see the price decrease near the end of the year is because there's less sales happening. So the homes that need to sell, they sell for lower, right? But what's also happening on the back of the scenes is that majority of the homes list in the spring, summer. And so at this point, when they start to see the prices start to plummet like they have been, they go, oh, well, wait a second, I'm not selling, right? So it's the people that need to sell that end up selling for less and dropping the market, and they have to, kind of race to the bottom, right? But then what happens over the next few months is that a lot of homes decide, okay, we're not moving, or you know what, I'm going to rent it out instead. The last couple of years, the amount of listings that have changed to rental is just, it's crazy. But that's really what happens. So that's why you see in January, December, January, it bottoms out. Now we start the year with very low inventory because the homes that need to sell, they sold for low. But then the homes that didn't need to sell, they canceled the listing.
Yeah, they're out.
Right? So now we go into the spring market where most buyers are looking to buy a home. And so now when we start off in the fall here, when we're having, 2 buyers for 10 homes, we then start off the new year with 10 buyers for 2 homes. And everything reverses, right? And that is, and we can take a look, and the last years they're pretty similar to this. It'll depend if it peaks, and the average price peaks in March, April, May, but you typically see it jump up and then hover a little bit in the summer, maybe go up and down a little bit like we did this year up to September, and then October, November, December we see it decrease, and that is true throughout all the years. And that's all, like the point that I'm trying to get to right now is that if you have been waiting for interest rates to go down, right, and you have been waiting for prices to go down, right now is that small window of opportunity where your purchasing power has now gone up and the average price has come down. And so where you were looking 6 months ago and you couldn't afford anything or you outbid, you have a small opportunity basically till the end of the year where you're able to sneak in while no one's looking, right? Because that's the real reason that I wanted to shoot this, because everyone is just talking about Bank of Canada. Every time the announcement happens, every realtor, every mortgage broker, that's what they put out there. They share the post from a news article that comes out there, but no one's talking about what this really means and what's going on. And the thing is, it's supply and demand. It's economics, is how it works. And it's crazy how fast things turn here, but the auto market's been like that, where it's just on off, right? And the best time to get a deal is when no one else is looking. And so the few smart buyers out there right now are taking advantage of this drop in interest rate, taking advantage of the low competition. But the thing is, it's 90% of conversations that we have with buyers right now is they're waiting for interest rates to go down. And so that's where, again, I have to speak to, when we're putting up the numbers on the board saying like, okay, well, look what happens when the average price goes up 50K. I mean, the average price went up, from 582 to 651 with the interest rates not changing, right?
Exactly.
And so to think that the average price is going to go up 50K when prices drop is actually extremely low. It's actually not true, right? It's going to go up significantly more than that, right? Between the ebbs and flows. But I mean, that's what you're looking at, right? So if you're waiting, till the springtime because you think that you're going to save another 50 basis points, you're probably looking at, more like you're probably looking at 100K, and not to shoot numbers out there, not to, talk, without basis. But
we can only talk about facts and we can't predict the future, but the numbers are there, right?
Yeah.
Like it's there. And you say until the end of the year, it might even be sooner. Like that window it arrives so quickly and can be taken away from you so fast too, right? So it's tough to judge how long that's going to be, but that window is now, right?
Yeah.
And my phone rings right now, and it's not somebody who's looking to refi. It's not somebody it's all the pre-approvals that have been there in the pipeline for the past year and a half, 2 years. Now they're calling. We're back, right? And this is just me. So imagine all the mortgage brokers getting the same calls right now. So do you want to see a shift in market maybe here? It could be sooner than we think, right?
For sure. And I think that's really what it is that, yes, the interest rate is going to get better, where people's approval is going to go up and your mortgage payment is going to go down. But what is that approval if you can't afford the home anymore, right? And so that's the thing too. It's not a sales pitch as to like buy now, but do the math now.
That's it.
Right? That's really because I saw it happen, right? Where COVID time and near that, all the news was home shortage, housing crisis, and people were just well before that they were saying housing shortage,
that's
right?
Yeah.
And then we're looking at the price going up 10%. The price went up 50%, in a year. And I mean, obviously, I have to run the numbers on that, but it definitely went up more than 20% a year for a short period of time. But then all of a sudden, the interest rate go up and the media changes, and it's wait. So like things haven't changed. That housing crisis that we had a few years ago, where we have a major home shortage, it hasn't changed. It just the people's affordability, their ability to buy has changed, and people haven't been able to buy. But try and rent a home right now, right? We went from having 10 offers on a home bidding wars to buy to having 10 offers on a home for rental, right? And so try it. That's where you see is like the housing shortage hasn't changed. And when I'm looking at that, I'm looking at the demand and I'm looking at the amount of people that are waiting to buy. And then as soon as they see it as the opportune time, and then they all jump in, as soon as the media is talking about how this is the lowest, as soon as we get the announcement saying the rates aren't dropping anymore, this is the best we're going to get, how many people are going to run trying to buy a home, right?
100%.
And I guess, you know what, I don't want to make it all, because we can't predict the future, right?
No.
And we want to make sure that we are evaluating all the angles that we have. So I guess the next question that I'll ask about would be on the opposite side of the spectrum, right? So we're looking at, right now being the opportune time because rates are down and prices are down, and, what's going to happen when everyone clicks in and is wise to this. And I think the only argument on that of, the price is not going up in the early next year would be the amount of renewals that we have coming, right?
Yeah.
And so I'll let you speak on that, right? But I'll just let you go for it.
Yeah, for sure. So 80% of the mortgages are coming up due 2025, 2026. That's a lot. Okay. And that's why I think you saw the government of Canada, the Bank of Canada, increase the rate so aggressive, is that they knew that these mortgages are coming up for renewal, and they knew it was going to be bad news for a lot of people if the rates were going to be extremely high. So a big jump, very aggressive, and to be able to start lowering. So these people that have the 1.69s, the 1.89%, are not in a total state of shock when they go to renew, right? So the smart part on them to start bringing it down for those people that are coming. But again, when you're looking at the prices, some people are still going to have a hard time making the payments. I mean, we have ways to sort of try and help by bringing the amortization higher, to try and lower the payments. But again, some people might be forced to sell at some point. It's inevitable that not everybody's going to be comfortable with the new payments.
For sure. I mean, like looking at it on that face value, that is something that I've had in the back of my mind, wondering, how that's going to affect the market. But the more that I look at that, and the more that I look at the other aspects, and correct me if I'm wrong or if you see different insights of it, that is where the Bank of Canada reducing the rates does make a huge difference, right? And the fix coming down, right? So a lot of the people have been hurt. They've already been on variable this whole time, right? So they've already been doing it. So we're really only talking about the people that are on fixed term that are renewing, correct? Yeah. And we know that the majority of people that purchased at the height of the market went variable, right? So the people who paid the highest price, like they were already on variable, and they're not up for renewal, right? So the majority of the people that we're talking about that are up for renewal on the fixed term, have purchased either right at the beginning of it, or somewhat later, or maybe they were variable, they switched to fixed, in which case they're kind of pushed out even further for when they renew. But I think, I guess what I'm really getting at is that, yeah, it's more unaffordable, but the majority of these people that are on the fixed terms that we're renewing, they didn't pay anything close to what homes are worth today.
Of course, yeah.
Right?
And I'll throw you another one is, we work with different types of lenders and banks, obviously. Most of the lenders that we have, if the Bank of Canada, on a variable term, okay, if the Bank of Canada makes the move, you're going to see either the discount, or if they go up, you're going to see your payments go up every month. So it's adjustable. So it's going to go up and down. Major banks don't do that. Major banks actually keep the same payment to be able for you to budget monthly, which is smart. But what they do is that they change the amortization of your mortgage. Now, on a regular year, it's fine. You're keeping the same payments. It might go up by a year if they go up. But in this new age where the interest rates went up significantly, we have mortgage statements coming in, and the amortization is up to 68 years.
Okay, so you're right. I did know that, and I forgot about that. So that is the one thing that we got to watch out for is
right.
The
so they have
that
to bring that 68 back to 30, and that just increases the payment. So anybody in our database that were on there, we did email to and to see if they wanted to contact their bank to up their payments to what they're comfortable with, but at least there's something else. So it's not going to be that much of a drastic move once they get to the renewal part. But yeah, it's.
Yeah, and so I guess really I'd love to talk about this more, because everything that I see shows like a turnaround where we're going to go into a little bit of a feeding frenzy here when it comes down. But I guess that is the one aspect that we got to look at, is that again, it comes to supply and demand and inventory, and if we have a lot of inventory, but at the same time too, right, is that people who need to sell are going to sell. But I think in Ottawa we do have a pretty conservative type of people, right? And so are they going to get rid of other, lifestyle expenses before their home, right? Especially when we're looking at the equity that they have.
Of course.
But actually, you know what? I think I just came up with another reason to shoot a next video. Is looking at the stats of, the amount of renewals like that we have coming up that are on these types of mortgages. When we're looking at seeing them and what the banks are predicting for what they're expecting. I'd be interested to see. Yeah.
The other one, the stat I'd like you to pull up too is it's already started. People are already forecasting sort of what the renewal is going to look like and what the budget is going to look like. It'd be interesting to know, because you said it perfectly, they're going to start weaving away before, your home is your last,
Yeah.
the last one you're going to get away. So if you have campers, ATVs, or any toys of that nature, they're the first to go. But look at cottage sales. Look at cottage sales right now. I've never seen more cottages for sale. I can't tell you the years, but at least 5 years. I've never seen it just on my lake alone. So I can just imagine, everywhere else are feeling the same thing. Like are the people starting to see, okay, like having two of these mortgages is just not gonna fit well.
Yeah, like so that's a area of the market that I haven't been paying much attention to lately. But it's interesting too because it makes a lot of sense for me as well because that's the other thing that went crazy during COVID, right?
100%.
Is that everyone had this free money and everyone
Can't go anywhere.
couldn't go
Let's
anywhere.
buy a cottage.
And so we had so many clients looking for cottages and all that type of stuff. And yeah, you don't hear as much anymore, but for sure that would make sense is that they're going to see a lot more of that. And I mean, I guess I don't like to speak about markets that I don't know about, but it's just another thing too is that when we look at the interest rates and how it affects homes and that type of stuff, and we look at the average income in a city like Ottawa, we look at the average price of a home and mortgage payment that goes along with that, and then we look at a city like Toronto and we look at the average income, and then we look at the mortgage payment and all that type of stuff, right? And I think in Ottawa, if we were to see issues, we'd see them a long way coming, right? Because I definitely do know that Toronto condo sales, are quite slow right now for those small condos, right?
Yeah, having a hard time.
Which makes sense, but that's another thing in Ottawa. We don't really have that condo market at all either, right? So there's a lot of similarities we got to look to other markets for on what's coming. But I think I'm getting excited now because I realize that there's a lot of stuff that we can dive into and I have fun like taking a look at it and shooting videos, share the rest.
I'm just talking about where I see, right? So
Yeah.
my lake, and I've never seen cottages go up for sale like that. It's and not necessarily selling, right?
Yeah.
Because I think they're trying to get COVID dollar as opposed to where it is now. So I think that's going to take a little hit as well on the purchase price if there's a lot. But it'd be nice, you could pull it up.
Yeah, for sure.
When you post it and just put it out there and see. I could be totally.
No, but I saw someone, and this is the thing is everything's so clickbaity these days, right? But I saw multiple people sharing this one cottage property that had bought the property during the height of it and had just sold for a significant loss, and it was being shared because of how that loss is. But it's really hard to determine what the market is based on one sale, right? Because you don't really know what's going on if that person's got it under a business and they're
That's
taking
right,
a loss
yeah.
for tax gains, or if they're going through some sort of nasty
Separation,
divorce
yeah.
that they don't care. So there's a million different aspects to a sale, right? It's the supply and demand. So I mean, I do now. I'm interested in looking into that because it's also too. I mean, I do have a lot of people that were looking for cottages, and still, and if there ends up being an opportune time for them to purchase, then that's that's interesting as well.
Yeah. So I'll go back on the renewal too portion, and we can put it to rest after. But what you're going to see in the next couple of years, and this is strictly mortgage wise, the banks are extending or they're sending early renewals to the clients 6 months in advance for their renewal. So my advice to everybody that's watching here is take your time, don't sign on the dotted line. An early renewal comes with two different things. One, you're switching your low rate mortgage right away to the higher rate. So that's number one. And the bank is utilizing the 6 months of that rate and making some good coin for those 6 months. And two, the interest rates are going down. So don't sign 6 months early. It makes no sense. They're going to keep going down. Shop. Don't take the rate that is giving. Talk to a mortgage broker who has 40 different lenders that he can sort of look at. That on our end of the business, when you're doing a renewal, banks will only offer you two different rates. So it's 25 years or 30 years, or less than 25 years and more than 25 years. Mm-hmm. Those are the rates that you get. With certain lenders, they will offer you better rates if you have more equity in your home, right? So if you have more than 35% equity in your home, you can get rates as low as what the person with the 5% down payment will do. So when I'm talking 399 for an insured mortgage, that could be for a renewal with equity over 35%. But the banks don't do that, right? So you got to be careful. So, my advice, don't early renew and do your homework, do your shopping, talk to a mortgage broker that could see if there's better offerings there. The banks are scared of losing market share. They've got a lot of their portfolios that are in those 80% renewal. So, they are going to do everything in their power to get you to renew earlier to be able to gain that market share. So that's my advice to the people that are out there, in that position where they're going to be renewing in the next year or so.
I love it, man. I learn every time I sit down and talk with you, man, because that's I always just want to help my clients out the best that I can, right? And so just having that option changes things a little bit, for sure. Like, I think that's the other thing too is that, it's so easy for people just to go with, what's in front of them and not realize that they can explore options and that there's alternatives out there.
100%.
So yeah, I think originally when I wanted to sit down and talk with you, I wanted to talk about what's going on in the market and then maybe get into more basic stuff. But I think we covered a lot today.
Yeah.
So I think we're just gonna have to stick a pin in it and make sure that we come back another day to get
for sure. And it's good that we're showing the graphs, we're showing the stats, and it's not me or whoever coming on the mic and saying, "Oh, go buy a house now. It's the time to buy." It's not what we're trying to portray here. We're just showing the trends. We're showing how the market reacts and what the forecast is for the future, and hopefully the viewers take it like that and not like a sales pitch. You said it perfectly. You want to help your clients, so do I. It's getting them the best deal and getting them to be able to save as much money as possible when they're doing this big purchase.
No, for sure. Right? I mean, and the reality is helping people, and from talking to you, from being on top of the interest rates, we've had so many more rental clients that we've dealt with for the last couple of years. We really had to get into it. A lot of people who are looking at selling a home, they switched to renting it. But the renters right now, like I said, they've been kind of fighting for these homes, right? And the rental market has gone up astronomically, right? And that's where just this week we were able to help a client. We were looking for a rental. The prices were just crazy what we're looking for, and we were losing out on them. And then they sat down and they reapplied, right, for their mortgage based on the new qualifying rate, based on interest rates and predicting of what we're going to look at, and they ended up purchasing a home, with monthly payments that are not much different than what they would have been paying to someone else's pocket, and that's like, that was like the best feeling ever, right? Is legitimately helping someone from having this astronomical monthly cost that was just going into someone else's pocket to now owning home, and I strongly believe that house, that what they got it for a great deal because no one else was looking. And I think in a year when that lease would have been done, the amount of equity that they're going to have gained is going to be amazing.
100%. And for a good segue for our next one, we'll leave a last subject is, why is a renter paying $2,700 to $3,000 for a townhome, but they can't get approved for a mortgage with payments of $2,000?
Yeah. I mean, yeah, for sure, right? And that's the thing.
And they're supposed to save money on top of that to purchase a house. So
I'm scratching my head, because there's so many renters out there that to get the house they have to put 6 months down. Yeah. It's like if you're putting 6 months down, you have that kind of money down, like you have options, right? Crazy. And so that's the thing. It's when you don't have options, you got no other choice but to rent and save. But a lot of these people, I mean, it's just. That's the difference is that landlords have been so picky because they can pick the cream of the crop, where these people that have been renting for the last couple of years have no reason renting, right? Like their incomes, you know, traditionally they should be owning a home, and they've been pushed out of the market because of what's going on. And that's the positive of what's up
Yep.
right now with the interest rates coming down and the prices being where they are. You know, it's the difference between renting and owning, and you know that was the main reason behind this podcast, and I learned a lot more too. So I'm excited to do another one.
Perfect. Good to see you here, and again, love the studio. And anytime you need me, I'm here.
Awesome, man. Hope you guys enjoyed that. Thanks for watching.